Hey everyone, welcome to Talk of the Town. This is a podcast where we talk about all things media, creators, business, and more. My name is Tristin. I'm the host of the podcast. Today, guys, we got a really special episode for the podcast. This is actually the first guest episode for the podcast. This is actually a really interesting conversation I had with Jonny Price, who is the head of fundraising over at WeFunder. We talk about startups, raising venture capital, all sorts of different things. Really interesting, again, conversation that we had and everything. So, without further ado, let's hop into the episode. Today, I've got a very special guest on the podcast. I'm going to let them introduce themselves because I don't think I could do a good job of introducing them. So go right ahead, Jonny.
Sure, thanks for having me on. Jonny Price here. I'm the VP of Fundraising at WeFunder. My personal background, I'm from the UK, grew up there, moved to San Francisco to work for a non-profit called Kiva.org back in 2011. Married an American girl, so that's kind of what brought me over here. Lived in San Francisco for 10 years and have been in Nashville for the last 2. And I've been working at WeFunder now for 5 years. And WeFunder is an investment crowdfunding platform that basically helps startups raise capital from their customers and community, from unaccredited investors as well as accredited investors. And so, yeah, I'm excited to tell you guys more about it today.
Yeah, absolutely. I mean, thank you for agreeing to come on to the podcast. Definitely, from the first time that you and I spoke earlier this year, I knew if there were a list of people I wanted on the podcast, one of those was you. As far as things go, first, I have to ask, since you're from the UK, which football team do you represent the most? Okay.
I appreciate that you said football there versus soccer. I'm a Man U fan. On the club side, my dad was a Man U fan, so he got me to support Man U when I was a kid, even though I was from London. And then obviously on the national side, it was a little bit of a conflict when England played the US. I did cheer for England in that stalemate, but yeah, it was pretty heartbreaking over the weekend when we were knocked out of the World Cup by France. I think undeservedly so. I do think England probably at least deserved to make it to extra time, but that was pretty painful. I was watching it in an English pub here in Nashville, which was a lot of fun.
Yeah, I mean, I sort of didn't always get into football, and for me, I think it was about 4 or 5 years ago. I just kind of became a closeted. Well, now the secret is out, everyone. I'm a Man U fan as well.
Yes.
So
That's it. Also, it's impressive that you became a Man U fan when they've been really terrible. 20 years ago when I was growing up, they were by far the best team, most successful team. But when Alex Ferguson left, they've just gone downhill. So hats off to you, credit to you for supporting them, even as the going has been tough over the last few years.
Yeah, absolutely. So, I guess talk about your work with WeFunder and what you do, and really, the startup world overall, because I feel like a lot of people don't realize that there's sort of this, I guess, like shift in the culture of where 10, 20 years ago you couldn't do a lot of this equity crowdfunding, whereas now you see companies big, small, in between, WeFunder having a lot of big name groups and VCs investing into crowdfunding.
Yeah, absolutely. So, I would say the vision of what we're doing, right, is the Green Bay Packers, right? So I was reading some article the other day about how the Packers have the most loyal and passionate fan base, right? And there's probably a few reasons for that, but because I work for WeFunder, my kind of argument as to why they have the most passionate fan base is because that is a team that is owned by the people of that town, right? Instead of, or maybe as well as, millionaires and billionaires. And so we just think it's really cool if, especially consumer-facing companies, want to open up their ownership to let their customers, let their community invest alongside VCs. And it's definitely not an either-or thing, right? So some of my favorite WeFunder companies, Replit is a good example, Mercury Bank is a good example, Levels is a good example. These all have Andreessen Horowitz on the cap table, one of the best, widely respected VCs in the world. But then, Mercury raised a 120 million Series B and then opened up $5 million to let their customers invest alongside the VCs. So for me, there's value when VCs invest, but there's also value to you as a founder when your customers, when your community invest. So you're building this tribe and an engaged user base, kind of a loyal fan base. So that's kind of the big vision, right, of like why startup founders would want to raise capital from the community through a platform like WeFunder. As you say, legally, this is only a relatively recent thing. So for 80 years, the SEC said that the only people that can invest in private companies, pre-IPO companies, are accredited investors, right? Which is basically millionaires. It's like the richest kind of 5% of the population.
Yeah.
And so you either had to be an institution like a VC or a family office or an accredited investor. And then in 2012, the Jobs Act passed through Congress, and this was a new law that basically paved the way for now unaccredited investors to invest. The SEC rolled it out in 2016. And so, we've been leading the charge over the last 6 years in allowing everyone to invest in cool startups that they love, private companies, pre-IPO companies, as well as rich people.
Yeah, I mean, I know for a fact that, when I started my VC side of things earlier back in May, to this point now in time, I think probably it's like neck and neck even between you guys and Republic in the amount of companies we've invested into. Because like there's so many great companies that we've found over time, whether it's in the EV space, whether it's the real estate space,
right,
whether it's like fintech, you guys having obviously a really amazing deal with Y Combinator where you get to do a limited amount of their batches.
right.
I personally wish that like Y Combinator would come and say, okay, every single one of you guys are, all 200 companies, go crowdfund.
That'd be sweet. That's honestly like the future world that we're trying to build, right? Where right now, like the number of companies that are opening up their ownership to let their community and customers invest is a pretty small percentage. But in the future, we imagine a world in 5-10 years time where, especially for B2C companies, for B2B, like I don't think it makes quite as much sense. It can do, but generally this is a better fit for B2C.
Yeah.
But if you're a distillery, or if you're a brewery, or if you're a CPG company, or if you're an esports team, like the idea that you wouldn't let your fans invest in you
Exactly.
is seen as kind of weird. Like, why would you not get that competitive advantage? Why, like, for sure, raise money from VCs as well. They can lead the round, price the round, set the terms, add value, take a board seat, whatever. But the idea that you wouldn't let your customers invest, like, in a few years' time, that's going to be, like, weird, as opposed to right now, it's much more unusual to run a Reg CF campaign. And we call it a community round. We think it sounds way cooler to say community round versus equity crowdfunding campaign. But yeah, that's our hope. And in a few years' time, like every YC company is doing this because why not? Right?
Yeah, I mean, and you bring up a very good point about like esports teams crowdfunding. Like years ago I was like, it'd be great to see this happen. I make the joke, I live here in America, so like, when Fnatic did their crowdfund in like £2 million, I was like, can I give someone $50 and y'all like do this in my name? Because I can't do this unless I have like $20,000.
100%. Yeah, well, I can't remember when they did it, but yeah, now like it's actually surprising to me that more esports teams haven't done this in the US now with Reg CF, and even with Reg A, you can go up to 75 million. Like that's a lot more kind of onerous reporting requirements, but with Reg CF, it's pretty light reporting requirements. You do need financials.
Yeah.
You
I
know,
think
I expect more esports teams to do it going forward.
I think the reason why esports teams or a lot of creator economy brands have not done this, in gaming brands in general as well, is because with esports, you know, how, yes, you can do investor perks and all these types of things, but you sort of see more of esports teams and brands shifting towards these fan membership programs where you sort of feel like you're in that VIP press box, or whatever, franchise team
The
club.
box seats. Yeah.
Well, not necessarily box seats, but like how every year if you're a season ticket holder, you get a box sent out to you, or you get like, you paying $30 a month, you get content before everybody else type thing. I think it's also because, there's not enough people who have tested it.
Well, I think that the esports teams in the US that do it and embrace it early, and allow their fans to become owners, I think they'll see what the Green Bay Packers have seen.
Oh,
which is that
absolutely.
they'll see that their fans will be the tribe, the army, the passionate ones that are, and they'll have the best fan base. And I think as an esports, team, you want that, right? So
Yeah.
I obviously I'm pretty biased, right? But I feel like the early adopters here are going to basically get that benefit, and it's going to be an unbelievable way to differentiate, right? Versus other teams, like we are owned by the people, we are owned by the fans. We're the Green Bay Packers, and it takes the kind of premium, perks that you're talking about there, and for me, it takes it to its apogee.
Exactly. And again, like, the other thought I had about the creator economy is like I talked to a lot of brands, and go like, if you're a LinkedIn bio, realize Beacons on Republic like a year or two ago, right before Andressen and Y Combinator invested into them, or at the same time did a crowdfund, right? Why aren't you doing it, right? If you're trying to really build something for the creator space and really build something different, why don't you go out and do a crowdfund? If you're, a one-to-one mentoring platform, right, that's very similar to like a Day One or even a Maven, why aren't you going out and doing that? And I have conversations with founders all the time about why they don't. And so my next question is, why do you think there's still a lot of startups that are hesitant about doing crowdfunding? Is it something where it's we have enough experience where we know we can draw in VC money, or is it that they don't think that it's the right play for them?
It's a great question. I think there's kind of two main reasons. The first is a little more kind of tangible and kind of, harder to get around. The second is just a perception thing, and I think it will change over time. But so the first one is financials. So you need to, when you launch a Reg CF campaign, regulation crowdfunding Reg CF, this is the new law that the SEC rolled out in 2016. You need to publicly share financials. If you're raising more than 1.2 million up to 5 million, which is the legal cap per year that you can raise, you need audited financials. So that's like, for some founders, that's a bit of a pain in the ass to put those together. It costs a little bit of money and time to get the financials. But that aside, like some companies are reluctant to share financials publicly. You file this with the SEC, it's out there in the public domain. Your competitors could potentially then go and see your P&L, your cash flow statement. So if that's kind of a problem for you, a deal breaker, then that I think is a tangible reason. You have to be comfortable with your financials being out there in the public domain in order to do this. And then the second reason that I don't think it's had wider adoption at this point is more kind of intangible, and it's a little frustrating for me sometimes. But it's like this perception, it's a negative signal that you can't raise money from real investors, and say therefore you have to go the equity crowdfunding route. And I think sometimes that is the case, right? And actually, to be clear, WeFund is a public benefit corporation. Like, our mission is to get more capital flowing to founders who are struggling to raise from conventional investors, e.g., because there aren't many VCs in Lincoln, right? Or like Tennessee, where I live. And so if we can expand like who gets to be an angel investor, then we can get more capital flowing to startups. And so, that's actually a good part of why we do what we do at WeFunder, or why I work here. But like for a lot of founders, and again, you look at like a Mercury or a Replit, like if they're raising from VCs, if VCs are leading the round, and then they're just opening up some allocation to their customers at the end of the round, then where's the negative signal there?
Yeah,
Right?
it's like if it addressing Calm Company, you know, a Y
Right.
Combinator, Polychain Capital, whatever it is, if they're leading that round, if they're saying, "Hey,
Yeah.
we're comfortable with this. We've done this with enough
It
companies."
totally eliminates the negative signal concern, right?
Well,
And so then it's yeah.
not only that, and sorry for cutting you off there, but like that's one of the reasons why when I created the VC side of Spark, right, which is historically been an incubator for myself, I mandated to me really that I'm only going to invest into companies who are crowdfunding, or willing to pledge to opening a crowd fund, right? Because I see this problem, and one of the companies we actually invested into through WeFunder was NYCE, and they're trying to make
Cool.
like 100 million or 100,000 millionaires by some kind of year in the next like 10, 20 years, and I go, why can't we do that with crowdfunding and running a crowdfunded VC and then eventually open up a raise, and even. You talk about the mission with WeFunder. I mean, we invested into the WeFunder crowdfund back in August. So
Cool.
I mean, I as soon as I knew that was opening up, or someone told me it was like WeFunder opens it every 6 months, I was like keeping an eye, waiting out, watching. Boom, made that investment like that.
Love it.
So like that, I think you bring up some very good points about that. Now, before we go a little bit further in the podcast, I want to talk about a sponsor of the podcast, that being Zencastr. Zencastr is the ultimate all-in-one podcasting platform. They have bundled all your podcasting needs, from recording, editing, distributing, and monetizing your podcast, all from the same place. You get studio quality recording up to 4K and recording in 16-bit audio regardless of your internet connection. On top of that, you're able to sound the best through their post-production. You're able to host across multiple different platforms. And on top of that, analyze and monetize through Zencastr's Creator Network, Ambassador Program, and Ad Manager. If you want to see how people are using the podcast platform that Zencastr is, there's companies like Netflix, Spotify, CBS, The Atlantic, and Adobe that use Zencastr on an everyday basis. And it is a really amazing tool. It's actually what we at Talk of the Town use for doing all of our podcasts. So if you're looking to up your podcast quality and the overall, just nature of your podcast, go to Zencastr.com. That is Zencastr.com, or check out the show notes to find the link there. And
For me, like this negative signal thing that I mentioned, like it's just a stage thing, right? It's like I read the book Crossing the Chasm earlier this year, and I think like WeFunder and this regulation crowdfunding thing, community rounds, we're crossing the chasm where you have some kind of innovative, bold, early adopters, that are willing to do it, even though they could easily raise money from VCs. This isn't like, oh, we can't raise money, so we're coming over here because we need help raising the money. That's fine too, but like, there's some founders that like they could easily raise money from any VCs they wanted to. The growth rate they have, the opportunity they have, VCs are throwing money at them, but they say no. It's going to be cool. It's going to help me accelerate that growth, build stronger community if I can let my customers invest. So let me raise $5 million in a day on WeFunder from thousands of people in my customer base, in my community, now super excited about the chance to invest in me. And so, but there's only a few small examples of that. And over time, we'll get more and more of those examples, more and more success stories, more and more exits, more and more, big kind of exciting follow-on financing rounds.
Yeah.
And over time, I think we'll see more and more founders will jump over that chasm. It will become more and more commonplace. but we're still in the very, very early innings of the industry. And so founders kind of have to be a little more, innovative or kind of, entrepreneurial or kind of, willing to try it and take a bit of a risk just because there haven't been that many examples at this point. So that for me is like, a big part of why the adoption isn't greater. It's like the adoption isn't greater because the adoption isn't greater, and over time it'll just become more kind of familiar part.
And not only that, but I think a lot of people, and like this is a good example of where a crowdfunded company can make its way all to an IPO. Like Digital Brands Group actually raised through WeFunder and is publicly traded on the stock market today, right?
Yeah.
But,
Volcon is another good example. Volcon EV.
Yeah, exactly. So, like you think about that, a company that did a crowdfund has made its way all to, the stock market, the end goal. The same way that, you hope a lot of these, more credited companies you do. It's a real testament, I think, to the fact that it can happen, or that, some of these brands, like there's some that I've talked to before investing into who are like, we're doing our seed, and then our Series A, then our Series B, all like one after another, starting with the series, like the seed being the crowd fund, and then opening up a Series A again, partially on a crowd fund. And the whole time I'm just sitting there like, that is insane to think about. So I definitely agree with you. The more as time progresses and the more adoption there is and everything, I think we will continue to see it. I'm someone who, additionally, I'd love for the international regulations, between countries, whether you're living in the U.S. and want to invest in an Australian company, that qualified or accredited investors.
That would be cool, yeah.
Because, there's a really great company that does courses and learning material for creators in the gaming space, and I wanted to invest in them, but they're based in Australia. So,
right.
For me, I'm like, I don't fit the requirements, which kind of sucks.
Right.
The same way where, again, like, had I lived in Europe instead of the U.S., I could have went and invested in Fnatic, and I would have been,
right.
Great. One of these days I just want to be like, okay, let me go get Australian citizenship, and then hopefully that solves it. But
well, we are expanding into the EU, so that's exciting. We're kind of talking to the regulators right now. The laws there were kind of liberalized recently.
Yeah.
So we'll be expanding that soon. But yeah, again, it's like that's kind of mostly for EU companies raising from EU investors, and what you're talking about is a harmonization of like allowing American people to invest in EU companies.
Yeah.
Which it's not going to be possible just yet. Hopefully we can get there down the line.
Yeah, no, I mean it's certainly going to take like years and years of talking to various government agencies, trying to convince legacy finance to open the gates to it. So I definitely think, it's something that can be done eventually. And if it's done eventually, then, who knows? Now, this is the point in time with the podcast where I like to do something a little bit special, and that is, let you become the host of the podcast if you have questions or things that you want to get, my insight on or, ask me about, then, the floor is yours.
I would love to. Thank you. Yeah, I like this kind of flipping the script here.
Exactly. The reason why I did this is, I always listen to podcasts like Joe Rogan podcast. Well, I used to listen to Joe Rogan. But like I listen to like This Week in Startups or, all sorts of different podcasts. And you just see someone brought on and it's one person asking another questions, and you go in with that same flow, whereas it's like, you're bringing someone on to, taking the time out of their day to come onto the podcast. Let them have that sort of spotlight as well.
Well, thank you. And yeah, so I understand. I think I was, looking, I think it was on your Twitter, I saw this, or I can't remember where, but you started 15 companies, is that right?
Yes, practically. Between Spark, Awaken, and sort of the projects under Spark, it has grown to 15. Some were also companies that I had bought and I reinvented, like completely, like scrapped the name, kept a part of the name in them, and rebuilt everything. So 15 companies at the age by the age of 22 is certainly like a very daunting task. I'm not going to say that I've done good with that, good or exceptionally well at times, but I've always made sure that like I don't bite off more than I can chew.
Well, so then my question was basically what lessons you learned from, or have learned, the top lessons for other founders on, from, because I feel like every time you start a company, you probably have different, or acquire a company, whatever, those 15 experiences, you've learned different lessons each time. So what are the most, salient ones?
I mean, the lessons that I've learned, and I'm still learning lessons to this day, like for me, uh, one of the big things I've always learned is like, trusting people and giving the right people the right opportunities to do things. Like especially the esports team, I bring in people who might not necessarily have all the knowledge in a certain position or might not even know how to do a certain thing and throw them in there and try to help them. When it was building Spark, originally it started out as a consulting agency. I had to really learn how to work for somebody rather than like with somebody. And so
like to be a client, you mean?
yeah, and eventually over time, I had mentors that helped me understand. When I was pivoting Spark from being a consulting agency to an incubator of how to build a structure on a holistic model. I've learned from a lot of startups that I've worked on or talked to what to do and what not to do, and I still think I'm learning. Like the 22-year-old out there normally, will probably be like, I think I know everything. I'm good. I don't need, sit down talk about how to run a company. It is a very daunting task. I am 9 years into running an esports team, 6 years into running what is now a venture capital company, and I still don't know what I'm doing sometimes. So
Yeah.
I think other than that, it's um, I
So just to pick up, so you talked about hiring people
yeah
and trusting them, even if they maybe when you hire them are not kind of the right fit for the role.
yeah.
What are some of the other lessons you've learned along the way?
Some of the other lessons I've learned along the way, um, is to never be comfortable, right? Like this is one that I very quickly learned from being in the esports space and from the content space. It's like if you're very comfortable with the content that you're making and you're not trying to evolve, if you're running an esports team and you're not progressing, with the placing of rosters or social media over a given time, you're getting comfortable and allowing competition to sort of surpass you. And there's sort of a trade-off where I go, I can be comfortable, but I'm also still going to do better than everybody else, right? I might not.
How do you kind of challenge yourself to step out of your comfort zone and ensure that you are, not getting complacent, not getting kind of set in your ways? Like, are there kind of tricks or, are there kind of practices that you have implemented in your life to try to, fight against that?
I think the biggest thing I always do is I kind of take myself out of the equation and I look at what would someone else do in my position, and then or at the same time I look at a lot of these bigger esports teams, bigger venture capital companies, whatever the scenario of the company I'm working on at the time might be, and say, what are the big players at that space in that space doing, and how can I reverse engineer that to where I'm able to do it, right?
And do you set aside time like at your desk to think about that? Do you go for a walk? Do you like, are you talking about this with like a mentor or like colleagues, or like how are you? What is the like specifically like how are you setting aside time to think about this stuff?
So for me, a lot of it is I really don't go outside as much as I should. Um, granted, like it's 20 degrees outside, so I think like no person would really want to go outside in 20 degrees for a walk. But a lot of it is just like taking time to, you know, sort of relax and decompress from doing things, listening to audiobooks, podcasts. When I am dealing with something like talking, obviously, with the management team of the esports group that I run, or with the venture capital side, a lot of it is very much like me trying to figure, okay, what process works for me very well when wanting to invest in a company, or scouting, or whatever it may be. So a lot of it is sort of, and I think more of also talking to myself a lot, of looking in the mirror, or just like talking to myself casually and thinking like, okay, this is the situation, what do you do, how are you going to fix it, and I start talking just ideas on the paper. So
What about lessons from the VC experiences, the 6 years running the VC? You must have, I imagine you've learned a lot about, what mistakes that you've made on the investing side and things that have gone well.
Yeah, I mean, one of the earliest lessons I learned, and I'm still guilty of it, is not to scale too quick, right? Like during the pandemic, when Spark was still primarily a startup incubator, I saw a lot of companies, especially in the creator space, who were not looking to scale, and not taking risk. And I looked at myself and said, coming into 2020, I have 5 companies that I'm working on. By the end of the year, I had 11. Because if there was an idea that I saw out there that I realized was gaining traction, I wasn't wasting time on it. I was going to create something. Even if I decide, hey, I'm not going to do something with this brand for like 3-4 years down the line, at least I have an idea of, hey, this is here, this is waiting, and ready to go when I, one of the things I always mention about to people that I talk with is that the guy who created Instacart had like 19 startup projects fail before he started Instacart. So, I'm not saying that I've failed yet. A lot of them are just sort of like hiatus, or put on the shelf for a later date. And I've learned that even with the VC side of things is like, the average amount of investments for a VC in a year, unless you're like a Y Combinator, is, 24 to 30 investments respectively. We did that in 5 months. Like in October, we did like 7 investments through Republic and WeFunder. So like that right there is something that like a lot of people, including myself, would look at it and go like, okay, hey, you just had a really good month. Now slow it down, because otherwise you're going to dive off a cliff. And also because, again, not being an accredited investor, I don't have the ability to go, well, money means nothing. It's, hey, I have this limit of what I can spend a year or in a calendar year on investing. So, that's the biggest lesson I've learned on the VC side of things is find the right companies, and also don't scale too quickly with the amount of investment.
Proceed kind of methodically, and don't kind of
even one of the big things that I tell people all the time with the companies we invest into, and I'm probably one of the only people trying to build a VC, or that has a VC existing right now, that is probably willing to say this: I don't look at your financial documents when investing in the company, right? Like, I could care less of what your run rate is, or your annual income. If I believe that you have a viable product, a viable business model, that you have top tier investors in the knowledge of the space that you're in, I'm in. I'm like, I don't, I come from an industry where people spend $10,000-$20,000 an event on a team and get nothing out of it other than exposure. So I know what it's like in being in that case where, hey, if you spend $40, $60, $80,000 a month, that's just the cost of doing business. Now, before we get a little further into the podcast, I want to talk about another sponsor of the podcast, that being Ember Fund. At Ember Fund, they're fundamentally changing the way that people invest in cryptocurrencies by allowing anyone from around the world to buy into a managed portfolio of cryptocurrencies with just a few taps. This is very similar to the way that with Acorns, you can invest into a portfolio of ETFs or other types of funds. Their vision is to bring trading insights and technologies traditionally reserved for institutional investors to anyone around the world with just $300 and a mobile device. On top of that, Ember is fully decentralized and non-custodial, meaning that thousands of users that Ember has are in control of their own assets and individuals' mobile devices, making sure that there is no central point of failure. This is the first of its kind for the crypto space. So if you're really someone that's trying to get into cryptocurrency and investing, make sure to go to emberfund.io or check out the show notes. And with that being said, let's get on with the podcast.
Right. What do you have you kind of engaged with the founders that you're investing in, and how are you, or are you trying to kind of add value for them beyond the money, in terms of making connections, or helping them out in other ways, or is it more focused on the money at this stage?
So it's sort of a half and half. The way I look at it is we have an open door policy at Spark. If founders in our portfolio, not in our portfolio, want our advice, want our help with things, we're there to help, no matter who it is. With the founders in our portfolio, we always say engage with us, right? We can't, crystal ball and project that you need our help with something or that there's something that we can bring to the table. A lot of it, some of our earlier companies like Hero, which does, watch parties through mobile device and desktop, I loved what they were doing, and they were also trying to branch into the gaming space. And they said, well, you guys are talking to so-and-so team or so-and-so broadcast group. Like, let's try to see what we can do, right? There's not too many places in the gaming space, but like, hey, it'd be cool to be able to, launch, some gaming app and be able to live stream an event with somebody that isn't on a YouTube or a Twitch these days. On top of that, we look at one of our other companies we did was Meta Intro, which is a Web3 job platform, right? That basically creates wallets for the employee and wallets for an employer to verify credentials. And, I spoke with the founder, Lainey, and, I told her, if we ever start hiring at Spark or any of our portfolio companies, or,
we'll use you guys.
What's that?
We'll use you guys.
Right now, nothing. I mean, it's just me basically running the VC, and which by design. But ultimately, like, I told her when or if we decide to start hiring on any fronts, we're open to doing it with you guys rather than going through a LinkedIn or a Bamboo or whatever. So, there's still other companies who we talk to today about, hey, how could we do this? Or sometimes, there's companies that we know that we're investing in where we have no experience in any of what they're doing, and so we let them be. But, that's sort of the way things are.
Yeah, it's kind of a case-by-case basis.
Exactly.
Which do you prefer, investing in startups on the VC side or the operating side?
I mean, it's definitely a lot more fun and challenging to build a startup.
Mm-hmm.
But there's also times where it's just a lot more comfortable to invest into somebody and what they're doing, you know. Or talking again to a founder who wants to invest into or wants to start a crowd fund. You know, and like I've had numerous calls in the past month or two with people who it's like, I want to start a crowd fund, I don't know how to, or it's like, you know, I've had a couple companies I know of who are like, you know, do you think it'd be great for us to do a crowd fund? And I'm like, absolutely yes, right? And so, um, for me, you know, I'm sure I will always be out there trying to build something at some point in time, or scale, you know, an existing project. But right now, I find it just more comfortable investing into companies and, you know, sort of going at that pace where it's like, hey, I don't have to stress about, you know, going out and attracting customers, attracting users, trying to
Right.
compete against bigger people in every space that we're in. I can just relax about it a little bit.
Love it.
Yeah.
Interesting.
So I definitely thank you for the questions that you brought up and everything. Um, Going back to me hosting here, what I really want to know is, are there any? Actually, I'll rephrase this. So we're in this world right now where Web 2 and Web 3 are sort of, you know, transformating, right? You know, a lot of people from the Web 2 era are moving over to Web 3. And, you know, there's obviously the rise of DAOs and token funds and all things of these natures. Do you think that that's going to eventually disrupt equity crowdfunding in some way?
Yeah, probably. Uh, I think one thing that's interesting is that a lot of the principles of Web3, right, which are kind of decentralization, kind of stakeholder engagement, stakeholder ownership, a lot of those principles are what we're doing at WeFunder. It's just that, you know, we're kind of not using smart contracts or tokens, you know, to do it. The instrument, the equity instrument, is a kind of regular equity instrument that's, you know, logged in a kind of conventional database as opposed to, you know, a blockchain database. So a lot of the principles are actually very similar. So I think it's maybe a kind of a more primary frame would be that, you know, stakeholder capitalism, you know, decentralized kind of community-based ownership is disrupting centralized ownership, as opposed to the blockchain technology to implement that principle is disrupting the non-blockchain technology to implement that principle. That the disruption of like the only people that get to invest in startups are like institutions and millionaires is the more interesting thing that's being disrupted to me than like specifically the technology by which we're
Yeah.
implementing that. But yeah, I mean, yeah, I think like as with, I think a lot of the kind of bubble bursting around crypto over the last like 6 months or so
Yes.
has been kind of, you know, people uh, kind of having a little more skepticism around the use cases, right? And,
Yes.
you know, actually there's some benefits of having a database that is mutable or is centrally controlled. And so, you know, certainly for the moment, like I don't see like too much of a kind of functionality like improvement that would say, you know, okay, like a crypto based approach to equity crowdfunding is gonna, you know, come in and kind of you know, win out in the near future. But
Yeah.
down the line, like, could I imagine a future where every asset, like every, you know, real estate asset, equity asset, debt asset, kind of anything is being tracked with a blockchain based approach? For sure.
Yeah.
I don't know what the time frame on that is, and yeah, so certainly right now, I don't think the feature improvement, the functionality improvement, kind of merits the cost.
Yeah.
But could that be part of the future? Yes. It's certainly not in WeFunder's plans to build, kind of smart contracts and blockchains into the way we're administering things right now. But technically, like, if a founder wanted to do an STO and just, run a regulation crowdfunding campaign that is, you kind of file it with the SEC, it's, legally compliant, but they wanted the contract to be a smart contract or a token instead of a regular safe or convertible note. That will be fine, and we would certainly be open to that. We haven't done an example like that.
I know Republic has done a few, but like very far and few between for sure.
Yeah, I think and Republic is, which by the way, a great platform. We see those as our number one competitor. And for me, it genuinely is a rising tide floats all boats at this stage of the industry, which is very nascent. But yeah, Republic have definitely leaned more into crypto than we have. I think they've had more crypto founders on the platform. So I know they've done more in that space than we have.
Yeah, I mean, I think eventually there will be this time in the future where, because there's obvious similarities, a launch pad that allows for ICOs or smart tokens to be kickstarted, whether it's a Polkastarter, OKC, Binance, whatever it is. Like, those in theory are a Web3 Kickstarter or a Web3 WeFunder. I definitely get the the sentiment of crypto over the last 6 months. I myself have learned a few lessons that myself like 2 years ago would be like, Tristin, don't invest into this, or don't sink a ton of money into.
I think probably a lot of people have, yeah.
Well, I sunk like hundreds of dollars into a digital real estate thing, and then like it took me like 3 months of consistently spending like $50 here, $100 here, $200 here to be like, wait, what have I just done? Like, all of the guys I saw someone else do this as a business model, so it must make sense. That was my, like, if I could, if a time machine existed today, I would jump in it, go back to the time where I'm about to make
it's so funny, right, to me, like how quickly things turned, right?
Yeah, it's like watching the implosion of crypto, the semi-implosion of crypto over the last 6 months. Also,
you're still bullish long term.
I'm bullish on certain ones. Okay, your mainstays like Solana, Ethereum, Bitcoin, I believe in those. You're sort of like Dogecoins, like Luna, Cardano, all these other ones. I think like the technology is great, but the token, doesn't really provide a lot of value. I think if you look at the way like crypto is being used to buy things at convenience stores or retail, or buy food, or like what Coachella did, where they allowed people to essentially buy NFTs of lifetime passes, which went up like to the range of like $50,000-$60,000, right? Like, that's a very attractable, viable usage case where it's like, hey, this is tangible. Whereas like a lot of these, like again, what happened with FTX is very easy to see. This was a token that only was used for trading on the exchange, but they could print so much money of it, give it to a sister company, and they didn't think, oh, the sister company won't inevitably downfall us, and it did. So and even looking at like what they've been able to do, or what the Contagion has done, like reaching Genesis, and Genesis being like the leader in all these other areas. I'm bullish on crypto. I think crypto in Web3 will always have a place. I think what a lot of people right now are kind of going through is that period in like the 80s or 90s with snake oil salesmen who are like, you came into this industry looking to make a big buck and we all fell for you. And now we know what not to do and the signs to look for. Not saying that...
It's interesting to think, right, like, obviously there was a big dot-com bubble in 2001, right?
Yep.
And so probably then, maybe there were people saying, oh, the internet, like, yeah, like, the use cases for the internet are not that great, actually, and so, but and then there's a lot of bubble, and then obviously the internet becomes, like, huge and takes over the world, but then there's a lot of bubbles, right, where it's like, no, it really just was a bubble, and actually there weren't that many use cases, and so the market cap of crypto in kind of mid-2021, whenever the peak was, like, that actually is the biggest it will ever get, and so you can, even now, kind of after the bubble has burst, it's kind of tough to know, okay, is this 2001, or is this, like, another bubble that like actually did get too big, and the market size for crypto isn't ever actually.
Yeah, I mean, like, I made a joke to somebody one time. I was like, I was afraid it was never going to be able to own a single coin of Solana because at one point it was like $230, $250. Now it's like $15, $20. Like,
Right.
So like, that's something where I told someone, I was like, that says a lot about like crypto having a reset. Then it is what it is. Getting into the end of this podcast, I want to ask one final question to you. What does the future look like for you? 5 years down the road, and where do you think WeFunder is going to be 5 years down the road?
Yeah, I think I'll go back to what I said earlier. Right now, very, very few founders are opening up investing in them to their customers and community. And the vision we're trying to build is a world where, again, especially B2C founders, consumer-facing founders, in 5 years' time, the idea that you won't let your customers invest in your seed round, your Series A, your Series B, every round. Like, you let retail investors invest when you're public. Why wait until, like, 10 years into your journey in the IPO to do that? There's going to be benefits for you that come from letting your customers invest in every round. And by the way, it's not just like self-interest wise, like economically, it's beneficial for you as a company, and therefore you should do it. But it's also like when you IPO or when you exit and you make investors money, wouldn't it be cool to wouldn't it have been cool if at the Uber IPO, as well as making a few VCs money, they'd made thousands of drivers millionaires? Like, I think that would have been so cool. Just from a kind of, what the right thing to do is. And we're a PVC at WeFunder, a public benefit corporation. Like, our mission is about letting more people benefit from the wealth created by startups. So yeah, that's the vision we're working towards. And in 5 years' time, our vision is that as a B2C founder, it will be kind of weird if you don't let your customers invest in you. Why wouldn't you get that competitive advantage?
Absolutely. Well, again, Jonny, I really appreciate you coming on to the podcast and talking about this. And I hope you share the message with the people at WeFunder. I really love what you guys are doing. I wish for all the success. I'm going to keep looking for when some of these upcoming community rounds happen. I'd love for you to be able for you guys to drag some previous companies back in that haven't reached the stage of a DBG yet. So who knows? Because I talk to founders all the time of companies who I realize did crowdfunds and I miss them because wasn't there like a year or two ago, and I'm like, hey, if you ever open up, I'm here.
Well, send them my way. Send them my way.
All right.
Yeah, thanks so much for having me on. This has been really fun.
Absolutely. And for those listening to the podcast or watching the podcast, thank you for tuning in. Really means a lot to myself and everything. And there are going to be even more amazing guests on the podcast in the weeks, months, and hopefully years to come. But for that being said, if you want to follow the podcast on social media, Twitter, Instagram, TikTok, Talk of Town Pod. And we'll see all of you in the next one.
Thanks, man.